Good morning, everybody. Today is September 25th, 2020. As we finish up the third quarter and head into the fourth quarter, we wanted to give you a quick update. A lot of action in all markets, really. So we wanted to give you a quick update, and this will be quick. First, we want to go over interest rates. This is 10-year treasuries. Now, this goes back about 15 years, and you can see interest rates have been declining. COVID hits. Boom. We have sat down here at less than 1% at about 65 basis points. That's what you can get on a 10-year treasury. If you buy a 10-year treasury bond, it will yield 65 basis points, less than 1%. And you can see we kind of have support in here at this level. They have sat down here and kind of stopped. This, of course, COVID really helped that. I wanted to highlight something to you that's very important. 10-year yields are at about 65 basis points, 0.65%. Inflation is running about 1.7% according to the Bureau of Labor Statistics, what they put out this month. So we talk about real yields. Real yields are interest rates, in this case, the 10-year treasury, minus inflation. If you subtract inflation, what you get is negative, a little over negative 1%. So if you buy bonds in here that are yielding less than inflation, your return is negative in real terms. So real means after inflation in the bond market. So we are guaranteed to not keep up with inflation on a lot of bonds that we buy. So our interest rates are nominally positive, you might say. In a lot of the world, they are negative. This number is negative. Here in the United States, we have positive rates, but after inflation, you are still down. So it makes bonds less attractive. One of the reasons we went to gold earlier in the year, one of the reasons, not the only reason. Now let's look at the stock market. Now this is the New York Stock Exchange Composite. I like looking at this from time to time because it is a big, broad index. Lots and lots of stocks in here. And we've talked about this. Y'all are very familiar with this chart. This chart goes back about 15 years. About 5 years. Excuse me. So we were in a channel prior to the election, just in a sideways sort of grind with some negative downward movement here in 2015, 2016. Election happens right here. As soon as the election's over, boom, we start moving. We move higher. Then as we get into 2017, we kind of started digesting some of those gains. Now this downdraft here, 2018, this is when the Fed came out and said they were going to start trying to put less money into the bond market and support banks and get out of QE. Well, of course, that didn't work. The market didn't like that. And so they immediately came out and said, well, we're not going to do that anymore. So the Fed, this was all sort of the Fed drawdown. Now, this is 2019. Here in 2019, the Fed got very involved. They had some problems in the overnight market, which we will not discuss. We've discussed that a lot. And then COVID. Now, this is COVID right here, hitting and drawing down about 35% pretty quickly in March, ended in March 23rd. Then the Fed, the central bank, gets back involved and says, we're going to back up a bunch of bonds. We're going to print a bunch of money and put it in bank balance sheets. And so that caused the bond market and the stock market to rally with all this central bank involvement, all this government involvement in the markets. Now, lately, we've come down, and we're sitting right here on top of the 200-day moving average. So, again, we're still in this channel. A lot has happened. We're not going to go into the details of it. Stock market just boat raced right here. And then COVID, and then it boat raced again when the government got involved in these markets. So the government involvement in these markets has given us great pause. And So we've come down lately, and we're sitting right on top of this. We are watching this very closely, but we are still in this long channel. Now, I wanted to highlight one other thing. This line here, which to me is a reasonable line of support, matches up with this line across here. Will we stay in this channel? We're getting pretty close to maybe buying as it tests down in here. We're getting pretty close here to maybe make a small purchase in the stock market, and it'll be dividend related if we do purchase something. So we're watching this very closely to see if it breaks right here and gets down on this line. If it does, we'll probably step in and buy some high dividend stocks. Now, a lot of you have commented about the gold that we bought back in February and through the spring. Now, gold has come down lately. So I've gotten some calls about that. Now, right here, gold just kind of went parabolic. Here's about where we started buying right here, and then it went parabolic. It got way ahead of itself. The dollar got weak. Lately, the U.S. dollar against the euro and other currencies has been strong. That's pushed down the price of gold, so I decided to look at the gold chart. This is about a 5-year chart. So our thesis for owning gold is still intact, and the chart sort of backs up our idea. These are trend lines that I've drawn here. So we think gold has support down in here at 1800, 1775, 1750. Here's 1750 right here. We think that that has good support right here. So our thesis is still intact in our mind anyway. And I went back and drew a 20-year chart and drew some lines on it. And we think that the long-term trend for gold is certainly still up. And again, this is back in 2011 and 12. Gold had really been racing after the great financial crisis, really raced hard. And we think that provides some support as well for gold. So this long trend lines here, I think, are still intact. I think this support comes back over here again to 1750, 1775. And that support goes all the way back to 2010, 11. So I think that's still intact. Again, this is the 5-year chart of gold. Here's the decline, the recent decline. Here's the 20-year chart, and you can see this recent decline right here. And this is where it sort of went parabolic, got way ahead of itself, I think. But we think this support goes back to here, or we think there's support right in here, around 1800, 1750. So we think our long-term thesis on gold is still intact. Thank you so much. Just wanted to give you a quick update. Please call us if you got any questions about anything. Thanks so much.